Welcome to Iron Financial. We're the channel that's all about forging stronger portfolios by putting companies through the ringer and cutting right through the market noise. I'm your lead analyst.
And I'm your market skeptic. My job is to ask the tough questions you're probably already thinking.
Today, we are putting a true household name on the anvil, Mattel. And look, this isn't just going to be another boring earnings review. We're treating this like an autopsy. Because after the market closed on February 10th, this toy empire, well, it didn't just stumble. It hit a concrete wall at 100 miles an hour. Our job today is to figure out if the whole structure is shot or if the foundation is still solid enough to build on.
So take a look at this. Just let that number sink in. This is the cold, hard, after-hours reality for anybody holding Mattel stock. A quarter of the company's entire market value, poof, it just vaporized in a matter of minutes. This isn't just a dip. This is the kind of price action that screams deep structural fear from the big money on Wall Street. Whoa, hold on a second. How on earth does a 25% collapse happen to a name like Mattel overnight? I mean, seriously, we're talking about Barbie, we're talking about Hot Wheels. These are cultural institutions, not some fly-by-night tech stock with no revenue. Has the foundation completely crumbled here? Is this whole thing just a house of cards waiting for a light breeze?
That is the big question, and to answer it, we're going to put Mattel through the full Iron Financial stress test. First up, we'll get a handle on the immediate damage from this stock price collapse. Then, second, we are going to deconstruct their earnings report piece by piece to find the exact numbers that lit the fuse on this firestorm. Third, we'll start looking for the cracks in the toy box itself, which brands are failing and which ones are actually holding the whole structure up. Okay. And then we'll dig into management's brand new blueprint for 2026 and see if it's a real plan for reconstruction or just wishful thinking. Exactly. From there, we test the strength of the balance sheet. We'll see if it's the financial fortress they claim it is. And then, at the end of it all, we will deliver the official Iron Financial verdict. Is this a toxic asset to be avoided at all costs, or is it a foundational buying opportunity in disguise? All right, let's get into it.
You have to understand, a drop of this size, over 25%, it isn't just a simple reaction to one bad number. This is a full-blown panic. This is the sound of institutional funds, the big players, slamming the sell button with extreme prejudice. It's a massive vote of no confidence. It's the market saying, we think something is fundamentally broken here. Right. For most people, when you say Mattel, you think Barbie, you think Hot Wheels. These are brands that feel unshakable. You know, they're passed down from parents to kids, generation after generation. So to see a pillar of the consumer world just get sawed off at the knees like this, it honestly feels like an earthquake. It makes you question the stability of the very ground it's built on.
And here we have it, the official, very carefully worded excuse from the CEO himself. Let me translate this for you. This is the corporate speak equivalent of saying a Category 5 hurricane was just a bit of weather. For a toy company, growing less than expected during the all-important holiday season is an absolute unmitigated disaster. That's their Super Bowl. It's their entire year, and they fumbled the ball on the 1-yard line.
Okay, but really? Can one bad month, even if it's December, actually justify wiping out billions of dollars in company value? Is that all there is to it? Or is this, quote, just a convenient smokescreen for something much, much deeper, a more systemic rot that the market finally sniffed out? Because I'm sorry, that one little sentence just does not feel like it adds up to a 25% collapse.
You're absolutely right. It doesn't add up. And to really understand the fire, you have to go analyze the fuel. We need to push past the CEO's carefully crafted statement and get our hands dirty with the raw data that Wall Street's trading algorithms rip to shreds. The numbers, you'll see, tell a story of profound disappointment. And it's the sheer scale of the miss that's really, truly staggering here. This wasn't just a slight miss, this was a fundamental break from everything the street was modeling.
Okay, here it is, plain as day in black and white. That revenue miss of almost 4%, that was the warning shot. That told the market that demand was weaker than everybody thought. But the real kill shot, that was the earnings per share, the EPS. The analysts, they were expecting 54 cents. Mattel came in and delivered just 39 cents. That's a jaw-dropping 28% miss on the bottom line. That's a direct hit to the heart of profitability, and it signals a major, major problem with the business model.
But wait a minute, I'm looking at the press release here, and it says their Q4 revenue was actually up 7% compared to last year. So how does that work? How can your revenue be growing year over year, yet your profits completely collapse against what everyone was expecting? Where is all the money bleeding from? That's the billion-dollar question right there.
And the answer to that billion-dollar question lies right here with this one critical metric, gross margin.
The easiest way to think about this is that it's the financial engine of the company. For every single dollar of toys they sell, this is the slice of the pie they get to keep after paying for the plastic, the factory labor, and the shipping containers. It is the first and, arguably, the most important layer of the entire profitability foundation. If this number starts to weaken, the whole financial structure they've built right on top of it becomes incredibly unstable.
And this chart right here, this is the smoking gun. In the fourth quarter of 2024, their gross margin was a very healthy 50.7%. Fast forward 1 year, and it has plummeted to 45.9%. That is a 480 basis point drop. In the world of finance, that's not just a crack in the foundation. That is a sinkhole opening up directly underneath the main building. Now, the company's official reasons were, higher discounts, inflation, and unfavorable foreign exchange rates. Okay, let me translate that from corporate speak into plain English. They had to slash prices on their toys to get them to move off the shelves, and at the exact same time, it cost them more money to make and ship those very same toys. That is a brutal, brutal combination. That's not a blip. That's a deep structural weakness. It's a huge red flag that their pricing power is eroding and fast.
Exactly right. And now we have to dig even deeper. Because the overall numbers, as bad as they are actually hiding a deep, deep division in the performance of their individual brands. You see, this isn't a simple case of the whole structure being uniformly weak. It's much more like a divided house. Some parts of this portfolio are solid as steel. I mean, they're performing incredibly well. But other parts, they look like rotting wood, just about ready to give way at any second.
So look at the strong parts. The vehicles division, which is basically all Hot Wheels, grew by a massive 11% for the entire year. Action figures, which are usually tied to big movie releases, surged an even more impressive 14%. Right now, these are the load-bearing walls of Mattel. They are single-handedly holding the roof up. Okay, but Barbie and Fisher-Price are supposed to be the bedrock, right? The legacy brands that provide all the stability. And they're crumbling. For the whole year, the dolls category, which is mostly Barbie, saw its gross billings fall by 7%. And it gets worse. The infant, toddler, and preschool category collapsed by a catastrophic 17%. A decline of that magnitude isn't a trend, my friend. That's a full-blown crisis. Is the magic gone? Is that core brand loyalty finally cracking under the pressure of new competitors and just changing tastes?
And this question right here brings us to the absolute core of the issue. A bad quarter gets you a penalty from the market. Maybe a 5%, maybe a 10% drop in your stock price. But the market didn't just give Mattel a penalty. It handed down a death sentence. That 25% after-hours demolition wasn't just about what happened in the past. The real demolition charge, the catalyst that turned a bad situation into an absolute catastrophe, was hidden in the company's forecast for the year ahead. It was all about the guidance.
This single slide explains everything. Wall Street analysts, the so-called experts, had built all their fancy financial models assuming Mattel was going to earn about $1.75 per share in 2026. Then, on the earnings call, management dropped the bomb. They guided for a range of just $1.18 to $1.30. That means the company itself told Wall Street to expect up to 33% less profit than they were forecasting. This isn't a crack anymore. This is management taking a sledgehammer to their own building and telling investors it's a planned demolition of near-term expectations. But why? Why on earth would they guide so low? Are they just being incredibly conservative, trying to set a super low bar that they can easily step over later? Or is the business really, truly deteriorating that badly behind the scenes?
Well, in the face of this kind of collapse, you'd certainly hope management has a plan. And they do. They've rolled out what they're calling a new blueprint for 2026.
And the real question for us as investors is whether this is a credible, solid plan for a stronger future, or if it's just a desperate attempt to change the story and paper over the deep structural cracks we've just spent the last 10 minutes identifying.
Here we have the cornerstone of their new strategy, again from the CEO, Jan Kreis. He's talking about a brand-centric strategy to grow their IP-driven business. Okay, that is some prime, grade-A CEO speak. It sounds nice, but it's incredibly vague. What it means is they want to shift from just selling you plastic toys to monetizing their famous brands like Barbie and Hot Wheels through movies and video games and all sorts of other experiences. But I need to see the hard details. What are they actually building with this strategy? Where is the money going to go?
All right, here are the nuts and bolts you asked for. They're intentionally taking a $150 million hit to their 2026 profits specifically to fund this turnaround. This is the classic short-term pain for long-term gain argument. They're pouring $110 million into strategic initiatives, things like buying a mobile game studio, building out their direct-to-consumer websites, and investing in AI and toy innovation. On top of that, they're adding another $40 million to their marketing budget. The crucial point here is that they are telling the market, yes, 2026 profits will be terrible because we are tearing down a weak part of our structure now in order to build a stronger, higher-earning one for the future. It's a necessary modernization for sure, but it is a huge, huge gamble.
And this is a major piece of that new IP-driven strategy in action. On the very same day they released this disastrous earnings report, they announced this huge licensing deal with Paramount for the Teenage Mutant Ninja Turtles franchise. This is them bolting on a proven, durable, multi-generational IP to their portfolio. It helps diversify them away from their own struggling internal brands, which is a smart move.
It's a great move, I'll give them that. But look at the timing. The deal starts in 2027. What good does that do for the business now, in 2026, when it is clearly under extreme stress and investors are running for the exits? It feels a little like promising a rescue boat that's going to arrive next year while the ship is actively sinking today.
That's a completely fair point. And it brings us to what might be the most important part of this whole stress test. We've seen that the profit and loss statement is showing severe weakness. We know the brand portfolio has some major cracks, but the balance sheet, well, the balance sheet tells a completely different story. It tells a story of immense financial strength and durability. This is the bedrock. This will determine if they can actually survive the costly renovation they have planned for themselves.
Just look at this number. Mattel ended the year with over $1.2 billion in cash on hand. When you're in a crisis, cash is king. Cash is everything. This is a massive shock absorber. This giant pile of cash gives them the ultimate flexibility to weather these storms, to make that $150 million strategic investment without having to go into debt, and to basically survive the demolition zone that will be 2026. This is their war chest. And on top of that huge cash pile, the board of directors just authorized a new $1.5 billion share buyback program. This is a massive vote of confidence from the board in the long-term value of the company. They're essentially screaming at the market, you think the stock is worth 25% less today? Well, we think you're dead wrong, and we're willing to bet $1.5 billion of our own money on it. Or is it just clever financial engineering? Is management using the strength of the balance sheet to prop up the stock price because they know the core business is weak and their guidance is terrible? It's a valid question. Are they just buying back stock to distract everyone from the real operational problems? Because it can look like a vote of confidence, sure, but it can also look like a magic trick to divert attention from where the real problems are.
And that brings us to the final weigh-in. It's time to put all the evidence on the scale. In one corner, we've got all the structural weaknesses you've been hammering on. Those collapsing margins, the terrible guidance, the declining legacy brands. And in the other corner, you have this financial fortress, a huge cash position and a massive capital return program. We've got the current, very real cracks versus the future, uncertain blueprint. We have to decide if this is an opportunity to build a long-term position at a steep discount or if it's just a dangerous value trap.
Look, the bear case is all about the here and now. It's undeniable. The core business is under serious pressure, profits are falling today, and the guidance for the next year is just abysmal. The company is bleeding profitability from those collapsing gross margins, and its most iconic, historic brands are in decline. It's all happening in real time, and execution risk isn't just a bullet point on a slide, it is a massive, blinking question mark hanging over this entire turnaround story.
But the bull case is all about durability and future potential. That fortress balance sheet gives them the two things they need most: time and resources. You simply cannot ignore a $1.2 billion cash pile and a new $1.5 billion buyback. Hot Wheels is still an absolute powerhouse. The strategic move into IP is the right one. And with their leverage at only 2.5 times total debt to EBITDA, they are not in any kind of financial distress. They have the financial strength to survive this storm and execute the plan. The whole debate just boils down to your time horizon and how much you trust management to pull it off.
So after putting Mattel through our full stress test, here is the official Iron Financial verdict. Number 1, the 25% collapse, while brutal, was justified. That guidance shock was a material, negative event that forced a complete revaluation of the company's near-term earnings power. Number 2, the operational business has deep, undeniable cracks. The weakening of Barbie and Fisher-Price is a major structural concern. Number 3, management's blueprint to invest heavily in IP and digital is, we believe, the correct strategic move, but it is a painful, long-term gamble with very real execution risk. And finally, number 4, the balance sheet is the saving grace here. It is a powerful safety net that provides the company with the time and the money it needs to attempt this reconstruction.
Our final verdict is this. Mattel is not a value trap, but it is certainly not an easy win either. This is a classic fixer-upper with a rock-solid foundation. The current structure of the house is flawed, no question. It's showing serious wear and tear. But the concrete slab it's all built on, that balance sheet, is rock solid. For investors with a long-term horizon, I'm talking 3 to 5 years. For those who can stomach the volatility and noise of the 2026 demolition and renovation phase, the current collapsed price could be a foundational entry point to a rebuilt and ultimately more valuable company.
Right, but let's be crystal clear. Short-term traders and anyone with a low tolerance for risk should stay far, far away from this construction site. It is going to get very messy before it gets better, if it gets better.
And so we leave you with this final question to chew on. Management has placed a massive $150 million bet on transforming Mattel from a simple toy maker into a modern, IP-driven entertainment company. The plan is sound, the capital is there, but the clock is ticking. Will their investment be enough to build the new wings of the empire before the rot in the old foundation brings the whole house crashing down? That is the billion-dollar question. Thanks for joining us here at Iron Financial, where we forge stronger portfolios by putting them to the test.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.